Harry had a problem. $7,000 sitting in his savings account earning 0.5% interest. That's $35 a year. Meanwhile, his buddy Mike kept bragging about his dividend portfolio throwing off $200+ monthly. You need at least $50,000 to make dividend investing work, Harry thought. Wrong. That first dividend payment, $12.40, not life-changing, right? But by month 6, something interesting started happening. By year 1, Harry was getting payments that made him rethink everything about wealth building. Today, I'm walking you through Harry's exact strategy, his month-by-month dividend payments, and the one critical mistake that cost him $127 in passive income, and how you can avoid it. And stick around because I'll reveal what happens in months 9 through 12. The numbers will surprise you. The biggest mistake people make with $7,000? They either buy one safe dividend ETF and watch paint dry, or they chase 8% yields that get cut 6 months later. Harry almost made both mistakes. See, dividend investing with smaller amounts requires surgical precision. You need dividend growth, monthly cash flow, and diversification across sectors. Most people pick 2 out of 3 and wonder why their financial goals aren't accelerating. Harry's secret? He built 3 income streams within his $7,000 investment portfolio. Stream 1. Dividend growth engines that increase payments every year. Stream 2. Monthly dividend payers for consistent cash flow. Stream 3. High-quality dividend ETFs for diversification. Let me show you exactly how he did it. Harry didn't randomly throw $7,000 at dividend stocks. He studied investment research for weeks and created a deliberate asset allocation designed for maximum compound interest potential. Position 1. SCHD. $2,000, 28.5%. SCHD became Harry's dividend growth foundation. At $27.32 per share, this ETF doesn't buy random companies. It focuses on U.S. businesses with proven track records of increasing dividends year after year. Think Microsoft, Home Depot, and Johnson & Johnson. These aren't just dividend payers, they're dividend growers. SCHD requires companies to have strong balance sheets, consistent cash flow, and a history of dividend increases. Harry bought 73.2 shares with his $2,000. But here's something crucial Harry learned about fractional shares. When you buy $2,000 worth of SCHD at $27.32 per share, you don't just get 73 shares. Modern brokerages let you own 73.2 shares. That extra 0.2 represents $5.46 worth of additional ownership. How? Fractional share investing. Instead of needing exactly $27.32 for one full share, you can invest any dollar amount and own the proportional piece. That 0.2 share still earns dividends, still grows through compound interest, still participates in dividend growth. This is huge for dividend investing with smaller amounts. Every dollar gets put to work immediately. Position 2. VYM. $1,500, 21.4%. VYM gave Harry broad exposure to 400+ dividend-paying companies. At $136.60 per share, Harry bought 10.98 shares. This Vanguard ETF targets high-yield value companies, established giants across all sectors that return substantial cash to shareholders. While SCHD focuses on dividend growth, VYM focuses on current income from mature, stable businesses. Position 3. JEPI. $1,200, 17.1%. Now, Harry wanted monthly action. JEPI delivers monthly dividends through a covered call strategy on its equity holdings. At $57.32 per share, Harry bought 20.93 shares. JEPI owns stocks but also sells call options against them to generate additional income. This creates higher yields and monthly payments instead of quarterly. Position 4. Realty Income. $1,000, 14.3%. Harry wanted real estate exposure with reliable monthly dividends. Realty Income calls itself the monthly dividend company for good reason. At $57.90 per share, Harry bought 17.27 shares. Now you might wonder, how does Harry own 17.27 shares? Same fractional share concept. That 0.27 represents about $15.63 worth of Realty Income stock. It still earns the monthly dividend, still participates in dividend growth, still compounds over time. Realty Income has increased its dividend for 30 consecutive years. Those commercial real estate lease payments fund consistent passive income. Position 5. Microsoft, MSFT. $800, 11.4%. Harry wanted exposure to a dividend growth champion. Microsoft represents the perfect blend of technology growth and dividend reliability. At $513.71 per share, Harry bought 1.56 shares. Microsoft's cloud business generates massive cash flow, funding both dividend growth and share buybacks. Position 6. Apple, AAPL. $500, 7.1%. Harry's final position targeted the world's most profitable company. Apple at $213.88 per share gave Harry 2.34 shares. Low yield? Yes. But Apple's massive cash flow and dividend growth potential made it Harry's long-term wealth-building play. Before we dive into Harry's monthly results, you need to understand DRIP, Dividend Reinvestment Plans. Here's how DRIP works. Instead of receiving dividend payments as cash, your brokerage automatically uses that money to buy more shares of the same stock or ETF. Let's say SCHD pays Harry $53 in dividends. Instead of that $53 sitting in cash, DRIP automatically buys $53 worth of additional SCHD shares at current market price. If SCHD is trading at $28, Harry gets 1.89 more shares. Those new shares immediately start earning dividends. Next quarter, instead of 73.2 shares earning dividends, Harry has 75.09 shares earning dividends. More shares equal to more dividend income, equal to more shares purchased, equal to compound interest in action. DRIP is the secret sauce of dividend investing. It turns every dividend payment into an automatic investment that accelerates your wealth building. Harry's $7,000 investment portfolio generated 2 income streams: monthly base, JEPI, plus Realty Income. Quarterly waves: SCHD, VYM, Microsoft, Apple. Here's what actually hit Harry's account month by month. Month 1, January. Monthly payers delivered. JEPI, $7.74. Realty Income, $4.66. Month 1. Total, $12.40. Just the monthly payers, JEPI and Realty Income. Harry's dividend machine was officially running. Month 2, February. Same monthly payers, JEPI, $7.74. Realty Income, $4.66 month. 2 total, $12.40. Harry learned that dividend investing requires patience during the quiet months. Month 3, March. First quarterly dividend season arrived. The quarterly payers joined the monthly ones. SCHD, $53.44. VYM, $10.76. Microsoft, $4.68. Apple, $0.59. JEPI, $7.74. Realty Income, $4.66. Month 3. Total, $81.87. This is when Harry understood dividend seasons. Those quarterly waves when multiple holdings pay simultaneously. Month 4, April. Back to monthly payers. JEPI, $7.74. Realty Income, $4.66. Month 4 total, $12.40. Month 5, May. Another steady month building toward June's quarterly wave. JEPI, $7.74. Realty Income, $4.66. Month 5. Total, $12.40. Month 6, June. The full quarterly impact returned. SCHD, $54.78, slightly higher due to DRIP purchases. VYM, $11.02. Microsoft, $4.68. Apple, $0.59. JEPI, $7.74. Realty Income, $4.66. Month 6. Total, $83.47. Notice how SCHD and VYM payments increased slightly? That's DRIP, buying additional shares with previous dividend payments. 6-month total, $214.94. Now, here's where Harry's strategy got really smart compared to his friend Jake, who kept his dividends in cash. Jake started with the same $7,000 portfolio but didn't enable DRIP. By month 6, Jake's quarterly payments stayed exactly the same, $69.47 every quarter. But Harry's DRIP was automatically buying more shares. His March dividends bought additional shares that increased his June payments. His June dividends bought more shares for September. This is compound interest in action. Same starting investment, but DRIP accelerates growth exponentially. In month 4, Harry made a critical error. He saw an energy stock promising a 9.2% dividend yield and sold $700 of SCHD to chase it. Big mistake? That energy company cut its dividend in month 6. Meanwhile, Harry missed out on SCHD's continued dividend payments and DRIP purchases. Total damage: $127 over 6 months. The lesson? Sustainable dividend growth beats unsustainable high yields every time in long-term wealth building. Harry learned from his mistake and rebuilt his SCHD position using his monthly $200 additions. By month 12, several magical things happened. Dividend growth announcements. SCHD increased dividend 6.8%. Microsoft raised dividend 10%. Realty Income announced 30th consecutive increase. Apple delivered 5% dividend bump month. 12 results. Monthly base income, JEPI, $8.95 from additional shares. Realty Income, $5.33 from dividend growth plus DRIP. Month, 12 monthly. Total, $14.28. Quarterly income, using September as example. SCHD, $62.15 from dividend growth plus DRIP plus additions. VYM, $12.67. Microsoft, $5.85. Dividend growth plus additional shares. Apple, $0.73 month. 12 quarterly. Total, $81.40. Year 1, complete results. Total. Year 1 dividend. Income, $378. Same $7,000 investment plus monthly $200 additions starting month 7. Compound interest and dividend growth working together. The 3-year projection. Using actual dividend growth rates from Harry's holdings, here's his income trajectory. Year 2. Projection. Monthly base, $18.50 to $21. Quarterly payments, $95 to $105. Annual income, $480 to $546. Year 3 projection. Monthly base, $24.25 to $28. Quarterly payments, $118 to $135. Annual income, $645 to $747. Year 5 projection. Monthly base, $38 to $45. Annual income, $1,050 to $1,250. All building from his original $7,000 investment portfolio. But Harry didn't stop at $7,000. Starting month 7, he added $200 monthly to his dividend positions. This changes everything. With $200 monthly additions focused on his best performers, Harry's passive income projection becomes Year 3, $95 to $110 monthly income. Year 5, $175 to $205 monthly income. Year 10, $425 to $515 monthly income. That's when dividend investing transforms from hobby to serious financial independence building. Want to copy Harry's proven investment strategy? Here's your exact blueprint. 28% SCHD, $2,000, Dividend Growth Foundation. 21% VYM, $1,500. Broad Dividend Diversification. 17%. JEPI, $1,200. Monthly Passive Income. 14% Realty Income, $1,000. Real Estate Dividends. 11% Microsoft, $800. Tech Dividend Growth. 7% Apple, $500. Long-Term Wealth Building. Open a brokerage account with DRIP capabilities. Fidelity, Schwab, Vanguard. Enable automatic dividend reinvestment on every position. Buy in this exact order. Start with SCHD and JEPI for immediate income, then add others. Set up monthly contributions of $100 to $300 to accelerate compound interest. Focus on dividend growth over current yield. Avoid Harry's energy stock mistake. Use tax-advantaged accounts when possible. IRAs turbocharge dividend growth. Track your dividend calendar. Know when quarterly payments arrive. Here's what Harry learned. $7,000 isn't about immediate financial independence. It's about building the foundation for serious wealth building. Year 1, $378 in dividends. Year 5, $1,200+ in dividends. Year 10, $3,500+ annually. By retirement, this single $7,000 decision could generate $6,000 to $8,000 annually in passive income. That's how financial independence actually works. Slowly, then suddenly. You don't need $50,000 to begin dividend investing. You need $7,000, the right asset allocation, and patience to let compound interest work. The question isn't whether $7,000 is enough. The question is, when will you start building your dividend income machine? Copy Harry's allocation. Enable DRIP. Focus on dividend growth. Your future self will thank you for starting today.